Fortunately, many juniors are well cashed because previously the prices of the commodities were high and there's still a lot of interest.
Certainly the US, I think, deserve credit, and certainly Canada deserves credit for really starting to back localization incentives.
We need that to translate into more dollars going into these companies, but it's an encouraging first step and one that really throws the tradition of this very conservative auto industry out the window.
The anticipation is more friend-shoring or near-shoring, shorter supply chains, more economic security prioritization in this space, and sort of alliance-centered strategies maybe.
Welcome to another content session for the Assay Live and the one-to-one Global Online Tech Metals event. So joining me today to talk about supply chain security for critical minerals, I have Jack Better, founder and director at Project Blue, Ryan Castillo, managing director at Adamus Intelligence, Ross Gregory, partner at New Electric Partners, and Luisa Moreno, managing director of Tahuti Global. So I'd like to thank all of you for joining me today. And so the energy transition requires a greater and much steadier supply of the rare earths and other critical minerals to help with the build out of EVs and other renewable technologies. With China still dominating the critical minerals space, governments and companies around the world are noting opportunities to fill the supply gaps and develop resources on national levels. And then also with the breakdown in the supply chains that we saw throughout the COVID-19 pandemic, these really highlighted the need for more domestic producers and processing plants for these key minerals. So I suppose to kick things off, the supply gap for these key metals and minerals has been a huge topic of conversation over the past few years. Where do you think we'll stand in terms of supply and demand? And where do you think we're going to be seeing the largest gaps in supply moving forward? Maybe Ryan, if you want to kick us off there.
Yeah, sure. We often like to think about the supply chain for battery materials and for motor materials for electric vehicles as kind of like a Swiss watch, where all of these different cogs, all of these different materials need to move in perfect harmony or the watch stops moving. Looking forward, we have lithium, we have nickel, we have cobalt, graphite, manganese, a handful of rare earths that all need to come up in perfect harmony, or one will bottleneck the other. So aside from where the gaps will actually emerge, I think it's almost certain that we will see gaps, and that will put challenges on other markets. On the battery side of things, lithium is probably the greatest exposure, given that it's used ubiquitously across virtually all chemistries. But an often ignored blind spot in that battery supply chain is the rare earth side of things, where if we don't have enough rare earths to satisfy demand for permanent magnet motors for EVs, well, then a portion of the industry needs to use alternative motors that are generally less efficient, and thereby needs to increase the size of their batteries to continue delivering on that range promise that their consumers have come to know. So certainly those rare earths are a major blind spot, but there's vulnerability across the entire suite of materials.
Mm-hmm.
I'd certainly agree with that. Right, I like the clock or watch analogy, as you say. I mean, you've got lithium, cobalt, nickel, manganese, graphite, all needing to come on stream in meaningful quantities over the next few years at the same time. Otherwise, the sort of lithium-ion project is sort of derailed, though, or at least there are some choke points. I definitely agree on lithium. I mean, it's probably the one where you're seeing the biggest demand growth projections over the forecast horizon, the medium term at least, and not much capacity in the next couple of years coming on stream. I think cobalt's probably another one. We're forecasting peak cobalt, maybe to hit in the 2030s before substitution kicks in, but that's still going to need, in our view, about another 140, 150,000 tons of refined capacity. So where's that going to come from? Where's the feedstock going to come from? That's another 5 Matandas, another 5 of the biggest cobalt mine in the world. I think maybe another element on the battery space is it's not just about the pure units, it's about the type of supply and where that supply is coming from. I think manganese is a good example here. So there's plenty of feedstock. South Africa's got abundant resources. I think there's plenty of capacity for battery quality manganese metal and sulfate. But of the 15 or 16 producers that we're tracking, only 2 of those are outside of China. And is that going to fly with sort of Western requirements for local sustainable supply chains? Are they going to be able to consume Chinese material going forward? So it's not just about the supply and demand, it's the types of supply, I think, which might be really interesting as we move throughout the decade.
Yeah, absolutely.
I think it's important to never forget, and both Ryan and Jack have mentioned graphite. It does go into the anode, and it's sometimes the ugly sister, and folks forget about it. So it's tremendously important to have, especially in the immediate future, as it seems demand for EVs is increasing and production is increasing as well, that we have graphite, and not just natural, but as well as synthetic. So it's important to watch that space as well.
I think that's a very good point, Louisa. Graphite is often the poor cousin of the cathode, but there's no substitution occurring in any short period of time. There will be some silicon doping and some partial substitution, but the total demand is going to increase. And I think most people would agree that the synthetic carbon footprint and the cost of synthetic means that natural flake graphite is going to occupy a higher proportion of the anode going forward. A point, I think, and it goes back to the Swiss watch, you don't just have to compile the components of the watch. You've got to make sure the watch actually tells the right time. And the qualification of materials once they come out of a mine, whether it's raw materials or in a refined form, is a 2 to 3 year process. So you don't just open up a mine, start extracting and supplying material to an ecosystem until the users of that material actually qualify the product. And it is a very complex and long process. So I see lots of statements around the potential capacity to supply the growth of the market, but the pragmatic analyst would have a rather more pessimistic view and say, well, some of these mines will be licensed, some won't. Some of them will hit nameplate capacity within the predicted period, and some won't. And then of the ones that do satisfy those 2 preconditions, it will take them 2 to 3 years to be qualified via the supply chain when you include the downstream processing. So I think we've got a major issue looming.
Absolutely. I mean, it's interesting. You point to, it's a couple of years process to actually get those materials from the mine to market, or but what about kind of looking earlier? So I mean, into maybe exploration, because it does seem that there is not even enough kind of projected supply from the mines that we already have working. So investment into kind of new mines and into exploration seems to be kind of another critical factor in making sure that we are able to meet this demand. Do you see, I guess, funding flowing into exploration? Is this somewhere where people are focusing right now?
Well, the markets are, sorry, I jumped in.
No, go ahead, please.
The markets, as you probably have noticed, are fairly poor, and the volatility is very high. So during this time, it's very difficult for junior miners to raise funds. Those cycles, those economic cycles or market cycles, tend to delay projects. And so currently, it is difficult. Fortunately, many juniors are well cashed because previously the prices of the commodities were high, and there's still a lot of interest. But in the case of lithium, rare earths, even graphite, there has been other booms before, or other times where investors were very interested and they got poor returns. So I think as time has gone by and investors have started to get more familiar with these strategic metals, they are more careful So raising funds for early stage companies, you have to present very good results. So they tend to be more attracted sometimes to later stage projects. And so juniors are trying to rely on government for support, and that is not perfect yet. And so it is difficult. Yes, the projections, even if you put every single mine potentially in production for lithium, graphite, and so forth, it could still be difficult to meet. But it's obvious that most of them are not going to meet it. And as Ross said, there's also a timeline for permitting and that comes into play. So there will be definitely delays.
Mm-hmm.
To make a comment around, sorry, Ryan.
No worries. Please go ahead, Ross.
Okay. Just to make a comment around mining generally, an interesting statistic is that roughly 95% of the exploration activities in lithium is being conducted by juniors. Rio Tinto is probably the only major mining firm that is currently showing an interest in lithium exploration. The market cap of juniors tends to be much lower than the capex required to actually liberate a meaningful resource. And with lithium, rare earths, and nickel, often that market cap is between $0.5 billion and $2 billion. Graphite tends to be a bit lower because it's closer to surface and a bit easier to mine. But in the case of the other major metals, the lithium, cobalt, and nickels of this world, you need very, very significant capex, and that's not easily achieved, particularly when some of the juniors fall into the trap of giving away free offtake to cell makers without requiring project equity. So the best result for a funding outcome is probably 60% debt, and sometimes it's as low as 50 or even 40% debt because of the perceived processing risks or the country risks. And ECAs and other debt providers are not particularly comfortable with high leverage ratios for mining projects. So I think you're going to really struggle to see some of the juniors, even where they've got good resources, fund their mines unless they take a very aggressive approach with offtake, which is to say to the cell manufacturers and now the EV OEMs, you've got to put in really significant equity at the project level in order to achieve the offtake that you're looking for. And I think that's starting to occur, but there's still a lag between that and the typical playbook, which is give away offtake and the market will re-rate you. Well, that hasn't happened as much as it needs to happen. And again, if you think of nickel projects, the sulfide resources are almost all mined out for the high grade resources. So you're going to have to go to laterite. Laterite means huge capexes, it means HPEL, and then a downstream processing capacity. So a lot of money is needed. The governments are not giving away free debt or opening up their checkbooks for equity. So you've got to go to the usual project financing market, which is no simple feat. So again, I don't think people really perceive the obstacles to liberating some of these important resources.
Ryan,
Certainly.
do you want to?
Yeah, please. So as you alluded to in the question, exploration is an area that is underfunded, that the pipeline is insufficient for the demand almost across all of those commodities. But I would also say that it's probably the most funded portion of the value chain that is coming up behind us. So that's a scary reality when considering that there aren't sufficient investments going into conversion capacity or metal making or alloy making or magnet making in the case of rare earths. So we're walking into a position where, yes, we have more materials coming out of the ground, but they're not necessarily usable in that form until we build out all of these value chains and connect them to end users. So that will remain a major vulnerability for these markets and will perhaps hinder their ability to become fully domestic. So perhaps there's some North American and European and Australian collaboration opportunities, but failing that, then there is still a heavy reliance on today's major processors and producers, such as China. So there really needs to be a full emphasis on investing and building out across all of these value chains.
Another one of the really big themes at the moment is the focus on kind of nationalizing or more, having more regional supply chains. We've already started talking about kind of the role of governments in pushing these types of new ideas. What role do you see for governments? Are they following through on plans to grow their domestic industries throughout the metals?
Yeah, if I can just jump in off the top, I think there's two big roles that government can play. One is in helping define what the national targets are for things like electrification or for moving the grid towards more and more renewables. That signals to the market what that demand outlook looks like and therefore what the needs are for that. And then on the supply side, to help build out the supply chains to meet those needs, I think there needs to be a nuanced approach depending on what that region is. So in Europe, there's long been a kind of not in my backyard mentality with respect to mining. But for the region to become self-sufficient, it really needs to move past that and consider opportunities for developing resources. And in North America, I think, there's a variety of challenges, but one has been long permitting times, which is off-putting to investors that don't want to put money into a company not knowing if and when it will ever get green lighted and move forward. So that's another area where governments need to cut some of the red tape to help the upstream come up to meet that downstream demand.
Yeah, so in North America, we have seen Canada put aside or allocated $3.8 billion towards critical materials. And then in US recently through Biden administration to the Inflation Reduction Act has also made significant allocations in the hundreds of millions towards critical materials and developing the supply chain. The problem in the US, the way I see it though, is that the focus has been more on the supply chain development. Yes, there is support for refining, there is support for recycling, but then a lot of it goes for metal making and then manufacturing of electric vehicles and so forth. So if you look upstream, they're not really focused, it seems, at sort of helping directly or giving grants and credits to exploration companies as they continue to try and develop projects. So in Canada, however, there seems to be some appetite, and 3.8 billion will make definitely a difference. Half of that, actually a little bit more than half of that's going to go to Natural Resources Canada, and hopefully support pilot plants and demonstration plants of projects within Canada. So that's significant. I know Australia has made allocations as well. And the Europeans have spearheaded all of this long time ago, going all the way to Africa and be open to invest in exploration companies outside Europe. So there has been, I think, significant effort. Now we just really need to see those dollars reaching the exploration companies. I think that is so important for the whole supply chain.
I think one of the mismatches that occurs is that certainly in Australia and the US, you have a federal policy, and then you have various state policies. And with mining, the licensing often comes down to the state level, and different states have very different approaches from an environmental perspective and a cultural perspective, and sometimes rules around land claims by Indigenous groups and so forth. So it's not a particularly cohesive approach that's occurring, but certainly the US, I think, deserve credit, and certainly Canada deserves credit for really starting to back localization incentives. And they're not just incentives, there are disincentives as well. So under the Inflation Reduction Act, if you don't satisfy local content rules by certain dates in certain percentages, then the rebates don't apply for electric vehicles. So, look, I think it's not a smooth approach, but at least they're trying. Australia set up a $1.3 billion funding project called the Critical Minerals Facilitation policy run by a national office that has certainly provided some both grants and some funding, which needs to be matched one to one on an equity basis for certain projects. I think in the US, you'll see more of a focus on processing. I think in Canada, you'll actually see it going much more upstream. Australia, certainly in Western Australia, but some of the other states, you'll see more upstream as well, and less of an emphasis at the moment on downstream. So it's a little bit, how would you put it, piecemeal in its approach, but you can see an emerging wave of almost desperation to avoid the very dangerous dependency on a single nation for processing of these materials. And that's not just because of geopolitical issues. If you think of China, it's got such a huge domestic market that it's obviously going to prioritize providing output to the local EV manufacturers. And also that's the case in renewables as well. The largest growth in wind turbines globally and onshore and offshore wind is in China. So it's an unhealthy commercial dependency. So in summary, I'd say look, there are some good steps, but they're early steps and certainly not coordinated steps.
I think that's an excellent point, and also interesting to look at, while Australia, the Canada, and US are making these moves, what other governments are doing. You've got in Chile, with regard to lithium, the government looking at, the development of a legal framework for the sale of its concessions. You've got Mexico's Congress looking to nationalize its sort of, early stage lithium resources. You've got in the DRC with cobalt, you've got Enterprise General de Cobalt looking to sort of nationalize the artisanal sector, which is the cobalt sector's swing producer. In iron ore, you've got a new company looking to take more control of Chinese resources, the China Mineral Resource Group, I think with a $3 billion fund or something, really, I suppose, looking to weaponize a little bit China's firepower with regard to iron ore and steel, and probably try and do something about the fact that Australia accounts for nearly 70% of China's iron ore supply. So yeah, it's interesting to see different governments' approaches. There's a mixture of sort of nationalization and regionalization going on in different parts of the world.
Mm-hmm. What about the role of like OEMs within the supply chains? Tesla makes a lot of comments about buying up certain nickel mines or, going into partnerships with different types of companies. I suppose just trying to gauge what's your impression of the OEMs really getting involved with the mining side of the industry? They are being involved. I mean, they're reaching out to companies. Tesla is definitely reaching out to many of the companies and trying to secure offtake agreements. There are ongoing discussions. And many of the EV companies, surprise to me, sitting on the board of various junior mining companies, it has come to my attention that, EV manufacturers and battery makers and others are really very active, approaching rather sometimes early stage exploration companies. So it is happening. Mm-hmm.
I'd agree it's happening. I mean, I think every day we see a new MOU signed between, OEM X and normally a sort of project for lithium or cobalt or nickel. I suppose the question is the extent to which the OEMs are now moving fast enough. I think they are ramping up their interest, and I think they are ramping up their investment, but I wouldn't like to say it's too little too late, but I think we need to see much more of this and much more large scale investment rather than just the signing of MOUs with potential projects.
I agree with Jack on that. It's encouraging to see that automakers and OEMs are willing to engage with companies at such early stages. It would have been almost unheard of a decade ago to have a tier one automaker signing a binding offtake agreement with a pre-production nickel or rare earth producer. But the fact that we're seeing these moves today, I think really speaks to the urgency that they're feeling on these issues and the recognition that they need to be first movers because there is limited supply in the pipeline. There's even less that will actually reach production. So hedging your bets today is important. And we see this translate into the agreement with Tesla and Talon Metals, into the agreement with GM and MP Materials to supply them with magnets. So just as Jack said, we need that to translate into more dollars going into these companies, but it's an encouraging first step, and one that really throws the tradition of this very conservative auto industry out the window.
So it's a very interesting space to watch, because you have a tension between the cell makers and the EV OEMs. I get the feeling that the EV OEMs don't want to be captive to the cell makers, yet it's the cell makers that traditionally run chemical businesses and have the IP around the cell chemistry. So with the JVs that you've seen between GM and LGES and SK On and Ford and Stellantis and Samsung SDI, it'd be very, very interesting to have a look in 5 years' time as to who owns and controls the raw material inputs, and whether these JVs have merged or evolved into the EV OEMs actually becoming battery makers themselves. Just to comment briefly on some of the MOUs, again, I make the point that a lot of these MOUs don't have any project equity that goes with them. And particularly in the case of Tesla, whilst their name behind an offtake agreement will help re-rate a stock, Tesla is not in the business so far of actually funding mining projects. And I think it's a big trap for some of the juniors to seek some short-term gratification from the announcement of offtake, when ultimately that could cause them to become a stranded asset.
Yeah, that's really interesting. I mean, it will be kind of a watch this space to see kind of how that all plays out. We've talked a little bit about the kind of the shift away from China. I guess my question is, what are some of the impacts that we're seeing from this shift away from kind of the processing and refining of these key metals in China?
I would suggest that the shift is early stage, and that there isn't a lot of processing that has yet left China, but we're seeing momentum in that direction. Ultimately, China has built up this dominance in processing and production of so many materials by historically leveraging the lower environmental practices of producing those materials that others would have to incur. I think we're moving into a reality where we're going to soon have a tangible value on the difference in those environmental practices, and that will translate into tariffs or other penalties that level the playing field and help expedite the movement of that processing capacity back to the West, or just shifting some of it to the West. The good news is for all that looking ahead 10, 15 years, there's almost more demand to go around than can reasonably be satisfied by just China or just the West, or even all collectively. So I don't think the real competition in the space will be felt for another 10 or 15 years until that market growth begins to taper, and there aren't a lot of growth opportunities for producers to seize, and they now need to compete with one another to capture more and more market share.
I certainly agree with that. I think it is early stage, and it's going to be a long path towards any decoupling, but it does feel that the brakes are starting to go on with regard to globalization. I mean, the last few years have seen trade wars and sanctions and divergent responses to COVID, and I think at the center of this there is a US-Sino decoupling that's much wider than critical materials, and critical materials are still going to be a key battleground or area of interest within this. I think you've also got Russia this year re-emerging as a sort of Cold War style foe, so it's a return to big spheres of influence. But it is early stage. I mean, the anticipation is more friend shoring or near shoring, shorter supply chains, more economic security prioritization in this space, and sort of alliance centered strategies maybe. But fundamentally, can there be an energy transition in the West without China? Can this happen ever, if not certainly in the near term? So China's going to be a big part of these supply chains for a while. And I'd also agree with Ryan's point. Yeah, I think ESG as a area of interest, as a battleground here, is going to be very, very interesting. I think there's going to be divergent markets, ones that are happy to pay a premium for more ESG compliant resources in the West. So it'll be interesting to see how that plays out versus these huge demand growth projections and the need just to get as much global capacity as we can to meet that demand.
Mm-hmm.
I think there are a few questions pending, and Jack sort of alluded to that. Will the West or the rest of the world be able to produce these metals and then or these materials and compounds and then price them competitively, or are the OEMs or battery makers or chemical companies like Umicore and BASF are they then prepared to purchase these materials at higher prices and then pass that to downstream? Are we prepared to pay $125, $150 per kilo for neodymium and praseodymium, or would prices fall down to $50 and would that be economic? So that's just an example. Would lithium stay at $60,000 and $70,000 per ton forever, or would it come down to historical levels below $10,000 per ton? And would that be economic? Can we develop supply chains outside China at those levels? And are the downstream players prepared to pay a higher price for these commodities?
Again, a fascinating topic. Multilateralism and globalization are clearly under threat at the moment, and the geopolitics determines the fate of multilateralism. The concentration risk that exists around China is simply not justified commercially. So any risk management department for an EV OEM has to look at currency risk, market risk, customer risk, supplier risk, and so forth. And when you find dependencies where a single supplier, for example, can, if they were not to supply you, or if an issue were to occur, be it a force majeure issue or a geopolitical issue or just a pricing issue, such that would totally interrupt your supply chain, then that's unacceptable. It's unacceptable corporately and to your shareholders as a duty of directors, actually. So there has to be a move away from the 100% processing that occurs for spheronized purified graphite in China, the 70% for cathodes, the 93% for rare earths. That's not tenable, whether you're friend or foe of China. And then you've got some history to look at. Look at 2010 when China decided that it would teach Japan a lesson in the rare earth space due to a dispute over a ship and some islands, where they basically turned off supply for permanent magnets, NdFeB magnets. As a result of that, Japan, and it's the only country that's done so, set up its own rare earth and magnet supply through Lynas via Sojitz and metallization, tolling, and then the building of magnet production capacity in Japan. So they have an alternative. That's got to happen with anodes, cathodes, and cells and other components. And don't forget too, China has a huge dominance in processing, but it doesn't have, at least for a number of the minerals, a huge dominance upstream. So it's a net importer of materials. Mm-hmm. So it's an impractical hegemony, and it's come about because China has had the foresight over the last 20 years, not just 5 years, to do the dirty processing and to take a government approach where you subsidized industry. For example, the hydrofluoric acid that's used in purifying graphite comes from the hospital system, and it's virtually given to the processors for free. So the government has had a policy where there's give and take between industries, and it's been fine to run at a loss if you're building a market share that's dominant. So there's a lot that the West actually needs to learn from China, in my opinion.
Interesting. I feel like we've kind of answered what would have been my last question of, what do you see happening in terms of this regionalization or de-globalization. Though I think we're leaving with a lot of new questions that have been posed. But that's all, all of the questions that I had. I don't know if any of our panelists want to kind of share any final thoughts.
A quick thought from my side would be that, I would just add that, we look far ahead, and it's clear to all of us that we're moving towards a widespread electrification and a wide adoption of renewable energy sources. What's unclear is how quickly we'll reach full electrification or full renewables. But I think that we should certainly expect a bumpy ride along the way. We'll get there eventually over a long enough time course, but it will by no means be a straight vector there. And with that, we'll have bottlenecks, and we'll have surpluses, and we'll have price spikes and price drops. So, if you're a long-term believer, then keep your eye on the prize, but expect a lot of noise in the meantime.
I agree with
certainly
that.
Echo that. I mean, it's going to be a long journey ahead, right? There's no way that these markets can double, triple, quadruple in size without some bottlenecks. And I think in the near term, there will probably be some very short-term bottlenecks ahead. It's going to be a difficult winter, I think, in Europe. China's still wrestling with its zero COVID policy and a failing property and construction market. Maybe the US looks a bit more resilient. So yeah, maybe some challenging months ahead, but after that, there may well be a sort of recovery early 2023 that really helps to kickstart some of these critical material markets for another growth cycle.
Yeah, so I think in the near term, just I guess in the near term we'll still be dependent on China. And by the near term, I'm saying between now, 2025, 2026. I think 2027 is going to be a critical time. We probably will see more adoption of EVs. And that's where I think there's going to be significant potential shortages. So it will be interesting to see how we will, the rest of the world, be able to respond to that. But in the near term, I think China has the capacity, has the expertise, and we're highly dependent. So hopefully we are not going to go into any conflict. We're not going to see rather any conflict between the US or the West against China, because that will significantly disrupt the EV agenda, the green agenda generally, because a lot of these critical materials go into renewable technologies beyond EVs.
I would conclude that the move to electric vehicles is now irreversible. The decisions that have been made at the highest level by all, not just some, but all of the major OEMs that are household names, are such that they're going to, over the next 5 to 10 years, virtually wind down their ICE capacities. It's certainly in a number of jurisdictions. Some are happening in 5 years, some are happening in 10 or 15 years. It's not just a corporate decision, it's mandated by regulation in a number of areas. And you can't keep changing. Once you decide to retire the ICE vehicle manufacturing plants, that has huge ramifications when it comes to staffing, the supply of components, the implications for dealerships. You'll see cars being purchased online. This is the biggest transformation we've seen since the advent of e-commerce. So there's no choice now but to adapt. And I think bilateral and localized supply chains will become compulsory. We've seen huge logistics issues due to COVID. And currently you've got this absurd situation where you've got ore being mined somewhere, sent somewhere else for initial processing, sent somewhere else for refining, then sent somewhere else for being converted into precursor cathode active material, and then somewhere else to be put into a battery. That's not tenable. It's a terrible carbon footprint when it comes to transportation, and a terrible risk when it comes to logistics, which has been heavily disrupted. So I think it's going to be very rocky, as everyone said. But I think by necessity, we have to get there, and you will see a decoupling from China over the next 5 to 10 years, at least to the point where, while China will remain probably the number one processor of materials, the dependency will be significantly reduced.
Absolutely. Well, that seems like a really good place for us to finish. some really interesting points. I think there's definitely a lot to kind of look out for, and you know, just keep an eye on as we move forward with this energy transition. So I would like to thank all of our panelists for joining us today.
My pleasure.
Yeah, definitely we'll be seeing you all at in-person events soon as well. So yeah, thank you.
Yeah, thank you, Amy, and thank you, everybody. Really insightful and some great food for thought for myself this morning.
Yeah, same.
All right. Well, thanks, everyone.